Welcome back to MonsterInvest. I'm your host, Daniel. Imagine for a moment that you are a gardener, but you are not planting flowers that bloom for a week, dazzle the eye, and then wither away at the first sign of frost. You are not planting vegetables that you harvest once, eat for dinner, and then find yourself staring at an empty patch of dirt the next morning, forced to start all over again. No, you are playing a different game entirely, a much longer game. You are planting trees, mighty oaks, resilient walnut trees, fruit-bearing apple trees. Now picture this clearly. On day one, you walk out into your field, you dig a hole, the sun is beating down on your neck, sweat is trickling down your back, and your muscles ache. You take a tiny, fragile sapling, it looks like nothing more than a twig, and you place it in the ground. You cover it with dirt, you water it carefully, you stand back and stare at it, nothing happens. It looks exactly the same as it did 5 minutes ago. In fact, for the first year, it might even look like it's struggling, fighting just to survive the wind. Your neighbor, let's call him Mike, walks by. Mike is a trader. Mike is addicted to speed. Mike is planting quick-growing radishes. Maybe he's even growing weeds that look like exotic flowers just to sell them quickly to unsuspecting tourists passing through town. He plants them on Monday, harvests them on Friday, sells them for a quick cash profit, and feels like a king. But then Monday morning comes around and Mike has nothing. He has to go back out, break his back, and do it all over again. He looks over the fence at your tiny stick of a tree and he laughs. He shakes his head, rattling the change in his pocket, and says, "Daniel, why are you waiting so long? Why are you burying your money in the ground where you can't touch it? I made $50 today selling these radishes. I'm going to buy a new watch. You're missing out." But you just smile, you wipe the sweat from your forehead, and you keep watering. You know something Mike doesn't. Years go by, seasons change. Mike is still out there, sweating, planting, and harvesting every single week. He looks older now. He is tired. He is stressed. He has to watch the weather constantly. If it rains too much, his crop rots. If it's too dry, they wither. If the price of radishes drops, he can't pay his bills. If Mike gets sick, breaks a leg, or just wants to take a month off to travel Europe, his income stops immediately. The faucet turns off. No radishes, no money. He is on a hamster wheel. He has to keep running just to stay in the same place. He is rich in cash perhaps, but he is desperately poor in time. But your tree has grown deep roots. It's tall now, providing shade that cools the ground. Its branches are thick and strong. And now every single season, without you having to dig a new hole, without you having to break your back tilling the soil, that tree drops fruit right into your lap. You can eat it. You can sell it at the market for cash. Or better yet, you can take the seeds from that fruit and plant another tree next to the first one. Eventually you have an orchard, and eventually you don't have to work the soil anymore. You just walk out to your porch, drink your coffee, listen to the birds, and watch the fruit fall. Even if you sleep in until noon, the fruit still grows. Even if you get sick, the fruit still grows. Even if you go on vacation for 6 months, the fruit still grows. That orchard is your portfolio. The fruit is the dividend, and that state of drinking coffee while the fruit falls, that is the holy grail. That is what we call passive income. Today, we are diving deeper than we ever have before into the world of dividend stocks. We are going to talk about how to build that orchard so that one day, your money works harder than you do. We are going to explore why this strategy is the ultimate wealth hack for the patient investor, and why it is the only strategy that truly buys you freedom. So what exactly is a dividend stock? Let's strip away the Wall Street jargon and look at the mechanics. In the simplest terms, when you buy a stock, you become a part owner of a company. You are a silent partner. You own a piece of the furniture, a piece of the factory, a piece of the profits. Now, businesses go through life cycles just like humans. When a company is young, like a tech startup in a garage, it is like a teenager. It has endless energy but empty pockets. It needs every single penny to grow. It needs to buy new computers, hire more coders, run expensive ad campaigns, and rent a bigger office. It reinvests everything into research, marketing, and expansion. Think of Amazon or Google in their early days. They didn't pay dividends because they were busy trying to conquer the world. If they paid you cash, they wouldn't have enough fuel to grow the rocket ship. But other companies, usually the mature, stable ones, think Coca-Cola, Johnson & Johnson, or your local electric utility company, they are the adults in the room. They have already built their empire. They have factories all over the world. They have supply chains that span the globe. They have customers who buy their products every single day, rain or shine, recession or boom. They make so much cash that they literally don't know what to do with all of it. They don't need to build 1,000 new factories this year because they already have enough. So what do they do with that mountain of excess cash? They have a choice. They can hoard it in a vault, which investors hate because inflation eats it away, or they can decide to reward their owners. They take a portion of that profit, let's say 50% of it, and they mail a check directly to you, usually every 3 months. It sounds like magic, right? Money appearing in your account just for holding a share. You didn't manage the employees. You didn't handle the customer complaints. You didn't drive the delivery trucks. You didn't even attend the board meetings. Yet, you get paid. You get paid simply for providing the capital that made it all possible. But here is where the storytelling gets important, because the path to the orchard is full of landmines. There is a trap, a very dangerous trap that new investors fall into every single day. It's a trap of greed, and it looks very inviting. Let me introduce you to a fictional character named Sarah. Sarah is smart, ambitious, but she is impatient. Sarah hates her job. She wants passive income, and she wants it right now. She wants to replace her salary by next month. So she goes onto a stock screener website and sorts everything by one metric: dividend yield. She ignores the company name, she ignores the news, and she just hunts for the biggest number she can find. She sees a company, let's call it Sinking Ship Shipping Co. It has a dividend yield of 15%. Sarah's eyes light up. She does the quick math on a napkin at a coffee shop. She thinks, wow, if I put in $10,000, I'll get $1,500 a year for doing nothing. That beats the bank interest rate by a mile. That beats the market average of 4%. Why is everyone else so stupid? Why would anyone buy a stock paying only 3% when they can have 15%? I've found the golden ticket. So Sarah buys Sinking Ship Shipping. She puts all her savings into it. She feels like a genius. She tells her friends at dinner parties about her high-yield strategy. She thinks she found a secret glitch in the matrix that Wall Street missed. But here is what Sarah didn't understand. The dividend yield is a simple fraction. It is the annual dividend divided by the stock price. There are two ways a yield can go up. 1, the dividend increases, which is good. 2, the stock price crashes, which is very, very bad. Sometimes a yield is high not because the company is generous, but because the stock price has fallen off a cliff. The market knows the company is in trouble. The smart money, the hedge funds, the pension funds, they have already sold. They know the ship is taking on water. 6 months later, the truth comes out. Sinking Ship Shipping announces that their profits are down because oil prices spiked and nobody is shipping goods. They have too much debt and the bank is calling in the loans. The CEO steps down in disgrace, and then the dreaded news hits the wire. They can't afford to pay the dividend anymore. They cut it to zero. The stock price, which was already sliding, crashes by another 50% overnight. Sarah didn't just lose her passive income, she lost half her principal investment. Her $10,000 is now $5,000, and the income stream is dry. She is left holding a bag of worthless rocks. This is what we call a yield trap. Sarah chased the highest number without looking at the health of the tree. She bought a dying tree just because it had a few big, rotten apples hanging on it. She looked at the fruit, but she ignored the rotting roots. Now let's cleanse our palate and look at a different approach. Let's look at Ben. Ben is boring. Ben drives a 5-year-old car. Ben doesn't brag at dinner parties. Ben buys a company that makes toothpaste. Or maybe toilet paper, or maybe tomato soup. It's not exciting. It's not going to the moon. It's not AI, it's not crypto, and it's not blockchain. This company only pays a 3% dividend. Sarah laughs at Ben just like the Radish Farmer laughed at the tree planter. 3%, she says. That's barely keeping up with inflation. You'll never get rich that way. You're playing it too safe. Where is your ambition? But here is what Ben knows that Sarah doesn't. Ben isn't looking at just this year. He is looking at the compounding timeline of 20 years. He understands the power of exponential growth. This toothpaste company has raised its dividend payout every single year for the last 25 years. These are a special breed of companies we call Dividend Aristocrats. They have weathered recessions, wars, pandemics, housing crashes, and tech bubbles, and they have never, ever stopped increasing their payout. They are the survivors. Ben takes that 3% money, and this is the crucial step. He doesn't spend it on shoes. He doesn't spend it on a nice dinner. He treats it like seed corn. He uses a strategy called DRIP, a dividend reinvestment plan. When the company pays him $50 in dividends, his brokerage account automatically buys $50 more of that company's stock. He doesn't even see the money touch his bank account. It happens in the background, quietly, efficiently. It's the snowball effect. Year 1, Ben owns 100 shares. Year 2, because of reinvesting the dividends, he owns 103 shares. Year 3, 107 shares. Year 10, he might have 150 shares. But here is the secret weapon that nobody talks about enough: inflation protection. We all hate inflation. It makes our coffee more expensive. It makes gas more expensive. It makes rent go up, but for Ben, inflation is actually handled by his portfolio. Why? Because the toothpaste company has pricing power. When the cost of raw materials goes up, or when wages go up, they raise the price of toothpaste by 10 cents. You still buy it because you need to brush your teeth. You aren't going to stop brushing your teeth just because the price went up a dime. Because the company makes more money from higher prices, they raise Ben's dividend check. So while Sarah's fixed income from bonds or savings accounts is buying less and less every year, Ben's income is growing to match the cost of living. His purchasing power is protected by the very products he owns. So Ben has more shares because of DRIP, and each share pays him a higher dividend than the year before. It is a double compounding engine working 24/7. Fast forward 20 years, let's look at the scorecard. Sarah is still chasing the next hot stock, trying to make back her losses from sinking ship shipping. She's stressed, glued to the news, panicking every time the market dips red. She's still looking for that one lottery ticket that will save her. And Ben hasn't touched his portfolio in years, but that boring toothpaste company is now paying him a massive annual salary, and here is the concept of yield on cost. Ben might have bought the stock when it was $50 per share. Today it might be trading at $200, but his dividend yield is based on his original $50 investment. He might be earning a 15 or 20% cash return on his original money every single year, safer than a bond. That 3% yield he started with has transformed into a 20% yield on his initial capital. This is the secret sauce of generational wealth. It isn't about finding the stock that doubles overnight. It is about finding the company that pays you to wait. It is about becoming a silent partner in a business that sells things people need, not just things they want. So how do you actually spot these winners? How do you avoid the sinking ship trap and find the next dividend aristocrat? I want to give you a mental framework to use, a checklist to protect your hard-earned money. You look for 3 critical things. Number 1, the payout ratio. This is the most important safety check. The payout ratio is the percentage of earnings a company pays out as dividends. If a company earns $1 per share and pays out 99 cents, that is dangerous. They have no wiggle room. If they have one bad quarter, or if a machine breaks, the dividend gets cut. You want a company that pays out maybe 40 to 60% of its earnings. This means they are keeping enough money to run the business, pay off debt, and survive a rainy day, while still rewarding you handsomely. It's like having a savings account for the business itself. Number 2, history of growth through crisis. You don't just want a company that pays dividends, you want a company that grows them when times are tough. Look at their chart during the 2008 financial crisis. Look at 2020. Did they cut the dividend when the world was panic selling? Did they panic when everyone else did? If they kept paying and raising their dividend when the world was burning, that is a resilient business. That is a management team that cares about shareholders. That is a company with a strong backbone. Number 3, free cash flow and a moat. Accounting tricks can manipulate net income, but cash is fact. Dividends are paid from cash. Look for companies that are cash cows, and look for a moat, a competitive advantage. Do they have a brand nobody can compete with? Do they have a patent? Do they own the pipelines? Do they have high switching costs? If they have a moat, they can protect their profits and your dividends for decades against competitors who want to steal their lunch. Now I want to leave you with a summary, a quick checklist of what we have learned today so you can carry this with you. First, we learned that dividend investing is like planting an orchard. It takes patience. It is boring in the beginning. It requires you to ignore the radish farmers who are getting rich quick, but eventually, the fruit falls without you working, providing you with true freedom. Second, we learned about the yield trap. Never, ever chase a high percentage yield blindly. If a yield looks too good to be true, it is usually a warning sign, not an opportunity. Don't be seduced by the big number. Third, we discussed the power of yield on cost in beating inflation. A lower yield that grows every year is far more powerful than a high yield that stays flat or gets cut. We want growth, not just income. And finally, the magic of drip. Reinvesting your dividends is the fuel that turns a small snowball into an avalanche. It is the engine of compounding. Building a passive income stream isn't about being the smartest person in the room. It isn't about having a high IQ or complex algorithms. It is about being the most disciplined. It is about controlling your emotions when everyone else is freaking out. It is about understanding that time is your best friend. Start planting your trees today, even if it is just one small sapling. Water it. Reinvest that first dividend, even if it is just a few pennies. Because one day you'll wake up, walk out to your porch, drink your coffee, and realize you never have to plant radishes again. If you found value in today's episode, please do me a huge favor. Hit that like button, share this with a friend who needs to start planting their own orchard, and make sure to subscribe so you never miss a strategy. Thanks for tuning in to MonsterInvest. This is Daniel. Keep building your wealth, and I'll speak to you in the next episode.